All right, well, many people spent the last days of 2017 calling their accountants, figuring out how the new tax bill affects them personally. But there are some things in the bill not getting a lot of attention. PwC partner Mitch Roschelle joins us now. Hey, Mitch, Happy New Year.
Happy New Year, Lauren.
New year, new tax law. What do you think is missing in the bill that a lot of businesses particularly would want?
I'll give you some bad news. So if you take clients out to play golf or take them to a ball game, all of those expenses are not going to be deductible starting on January 1. So those sort of corporate perks that businesses use to woo clients no longer are deductible under the new tax law.
All right, that'll impact the Wall Street industry, for instance. A lot of those, maybe husbands and wives will be coming home earlier, right? Less outings.
Although, but there are industries that are impacted. So private clubs get impacted. And the sporting industry, who spent a lot of money rebuilding new arenas and trying to finance those new arenas with luxury boxes. Most of those luxury boxes are subscribed to by big businesses. So there could be a knock-on impact on the sports industry.
Yeah, that's a very good point, Mitch, and we will follow that one. Talk to me about charitable deductions. They are still allowed, but many charities fear they won't be getting as much money. Why is that?
Yeah, well, similar to the housing market where everybody worried that the home mortgage deduction, which really wasn't changed all that much, was going away, which it wasn't. Charitable contributions are not going away. The problem is for most filers of tax returns, when you double the standard deduction, you sort of take away the incentive to give, because that incremental dollar may not be deductible because you're already getting this $24,000 deduction. And it really didn't get a lot of press going into when the president signed the tax bill. But the charitable world, the world of philanthropy, is very worried about it. And they issued some press releases towards the end of the year saying the impact could be as much as $20 billion a year. So it's something to look out for. We all have our pet causes, which we want to support, but this is something that could be impacted.
Let's hope that people get richer in general. They'll have more money, and then they just feel more generous and give to charity. Talk to me about repatriation, because with the new tax bill, there's concern that some companies, we've heard from many of the banks, Goldman Sachs in particular last week, saying, yeah, we're going to take a quarterly hit because of the new repatriation tax.
Yeah, so it's a one-timer because the tax law was passed before the end of the year, and there was certainty companies that had profits offshore that they hadn't paid taxes on that are deemed to be repatriated. Sorry for the technical talk at 5-something in the morning. There's a tax liability that they accrued at the end of the year. So there's a lot of the S&P 500 that's going to be recording tax liabilities up to as much as $200 billion. The good news is those funds are coming back to the United States. The other piece of good news is analysts expected this, so these aren't going to be surprises in fourth quarter earnings. Fourth quarter earnings may be down because of this one-time tax hit, but there aren't going to be surprises that would spook the market.
Yeah, and we hope with that repatriated cash that companies not only pay their shareholders, but maybe hike wages and help workers out as well. And we saw the start of that towards the end of last year.
We certainly saw that trend starting and reinvesting that in the business as opposed to buying back stock.
You got it. Mitch, thank you so much.
All right, Lauren, Happy New Year.
You too.